Hey, Dan Passarelli here. I hope you are having a good Wednesday. One of the stocks that I have been trading a wheel strategy on, specifically cash secured puts, for quite some time now, is this one, CLS. And I've sold a number of puts, and this period right here over the last, couple of weeks has, for the first time, I think, actually put my puts into the money. And my plan has always been to take possession of the shares of the stock. And so I want to show you what the best way to think about the average price of where I'll actually be buying these shares. So I short the CLS 115 put, which I sold at $3.09, and then short two of these CLS 110 puts, which I sold at $2.77. So the best way to think about this is this. This is the 115 strike, so that's where I'll actually be buying the stock, so 115. But I collected $3.09 on selling the put, so that would actually be minus 3.09. And then there was two of these 110 puts, and I'll just show you the easier way to do it, plus 110 minus what I collected for the put, minus 2.77, and then we just do that again because it's a two lot, plus 110 minus 2.77. And of course, we could have just doubled that in our heads, both the 110 and the 277. So that comes out to 326, and we just simply divide by the number of contracts. So I would be actually taking possession of it at $108, higher than where the stock is now, but that happens time to time when you're hoping to get assigned. But this doesn't really tell the whole story either, though, because in the past I had collected premiums over and over and over again also, and that just takes what I call the tracked cost discount effect, which is basically what we're calculating here, the tracked cost discount effect. Like, what price do I basically actually own this stock when I take into account where I got assigned and all the premiums I collected? So if I if I subtracted out all the other premiums I collected on selling puts in the past, that just lowers this more and more and more. Going back just the past 90 days, I see that the end of January I collected $2.64. The end of December, it was about $1. Beginning December 9th, it was $1.05. And, and prior to that, and prior to that, and prior to that. So it just lowers what some people call the cost basis. Again, I call the tracked cost discount effect. And that's kind of how I think about it. And so then if and when the stock ends up heading back higher and I decide where to sell calls, I don't have to get super hung up on trying to sell the strike that I actually bought it at, because if I take into account all the premiums I collect, then it emboldens me to sell lower strike calls so I can get bigger premiums and just make more and make the wheel work even better. I hope that helps. This is Dan Passarelli. Trade smart.